Hard to believe, but we are just about 2 weeks out from tax day, and while you may have already filed, turns out the biggest tax mistakes might be happening after you're all done. Joining us right now, Matt Eilers with Medalist Wealth Management to explain. A lot of people, of course, hopefully have wrapped that part of their year up. They've probably already filed, but what do we need to know? What are you saying the biggest problems still might be ahead? What does that mean?
Oh, absolutely. So when we say the biggest problems, I'm talking about a tax bill.
Okay.
So even though we may have just finished up filing and we're writing the check to Uncle Sam right now, it's not the only tax bill that we're going to face. And one of the things that I urge families in West Michigan to remember right now is that, filing your taxes is looking in the rearview mirror. And we really need to remember that we also need to look out the windshield and look forward in the future, because your biggest tax bill is most likely in front of you. And this is because of the way that we tend to save our money these days. So when we think about this, Tanner, I want you to imagine all the different types of money that you might have. It kind of lives in three different tax buckets. You've got a tax deferred bucket. These are things like your 401k or an IRA or a 403b or a TSP. These are all retirement savings accounts.
Okay.
The key thing to know about these is they're not taxed at all in your working years. They're not taxed until you start taking that money out, and 100% of that asset is taxed when you make that distribution in retirement. So for a lot of people, they are just shoving a ton of money into retirement savings, which saving is good. And saving for retirement is super, super important. But what tends to happen is the other two tax buckets, their taxable bucket and their tax-free bucket, tend to be much smaller. So they find themselves in retirement all of a sudden being forced sometimes to take money out of these accounts at whatever the future tax rates might be. There's something called an RMD, stands for Required Minimum Distribution.
Okay.
For most families, this is going to trigger when you're 73 years old. So you may be sitting there thinking, well, I've got all this money in this 401k, but I don't need to take it out because we're living off of Social Security income, other investment income, whatever it may be. But when you turn 73, Uncle Sam is going to force you to take a minimum distribution. That distribution could throw you into the next tax bracket.
Wow.
It could trigger excess taxation on your Social Security benefits, which, believe it or not, up to 85% of those benefits still can be taxed based on your situation. And it can also trigger something called IRMA, which is the Medicare tax bracket surcharge if you make too much money. So when we talk about how the biggest tax bill might be ahead, it's because of sometimes neglecting to do planning now to avoid some of these things that we know are coming down the road.
So it sounds like we're talking about two different groups, retirees, non-retirees.
Yeah.
It sounds like retirees have a lot to worry about when it comes to what you were just talking about.
Yep.
What other things do those retirees need to have in mind?
Yeah, I would take a look at a couple things here. Tax diversification is a big deal on all of your different assets, but also taking advantage of some of the tax opportunities that are at our disposal for these next 2 years. By way of the One Big Beautiful Bill Act, taxes are legitimately on sale through the end of 2028. So there's an opportunity right now to do what's called Roth conversions. Now, don't try and do this at home. It can get really messy if you don't know what you're doing.
Right.
But it's an opportunity to try and shift some money from that big tax deferred bucket that's 100% taxed over into a tax-free bucket so that, down the road, RMDs aren't affected in a bucket like that. So that's something that could be considered as well.
Let's talk about the people who haven't retired yet. What are some other things we need to be looking in the front view, or I guess the windshield, looking forward on the highway there?
What's really common here is that folks are saving sometimes maybe too much into a tax-deferred account. So what I mean by this is, let's say you have a 401k offered to you at your company and you're getting a 4% match, which is very common out there. Some people will say, okay, I'm going to save more. I'm going to save 8-10%, which is awesome to have that savings. But what you want to fast forward and realize is you might be building just as big a tax burden as some of the people that are near retirement right now are facing. So what I encourage viewers to take a look at is, inside of your plan, do you have a Roth 401k option or a Roth 403b option? And we see the vast majority of plans out there actually have these options. So what a lot of families will do is they'll say, okay, I'll contribute up to my 4% match in the pre-tax and get my free money because that's a match. We don't want to leave that on the table, take that money. And then maybe any of the excess is going to go into a Roth 401k or a Roth 403b. And now you're building tax-free income that you are, you don't have a silent partner with in the IRS. You have disinherited Uncle Sam forever on any Roth dollars.
Okay, let's talk about the biggest takeaways. We talked about a lot, right? So for both groups, what would you say are the biggest things we need to focus on if we haven't filed those taxes, or if we have, looking forward? What are the biggest things, biggest takeaways?
Yeah, well, it's April 2nd. If you haven't filed them, you better get to work right now. But I would really encourage you to take a look at, based on the situation of last year's tax return results, what you can do going forward to lower next year's tax bill or lower the tax bill in future years in retirement. And that just involves talking to somebody that understands tax strategy in conjunction with financial planning. So a lot of the times your tax preparer, they're not going to give you any advice in that arena in regards to how to manage your investments regarding your future tax burden, but have a conversation with somebody so you can make sure you're taking advantage of any loopholes or any opportunities that are at your disposal.
Let's talk about when we get a tax return. I think we're mostly talking about people who probably don't get a return at this stage in the game. But let's say we are talking to the viewer that does get that tax return. Maybe it's a hefty tax return. What's the smart way to divvy that investment up? My
goodness, I would first take a look at your emergency fund. Do you have enough sitting in the bank to cover 3 to 6 months of your needed living expenses? Use a return to pad that if you don't have that. Otherwise, I would plow that at any type of debt that you might have. Credit card debt, student loan debt, car loans, anything like that. If you've checked off those boxes and you have money that's left over, have some fun with it or save it for your future and maybe explore a Roth IRA or something of that nature.
All right, good advice. Always good to have you, Matt. Thank you so much for joining us. We'll see you next month.
Sounds good.
All right.